The Great Reset could be underway, and they're not coming through the front door, but rather through the back with a Trojan horse-style stimulus package, because they know the country could sure use it, and most of the country would gladly take it. But could it be a trap? Because this isn't your usual check in the mail kind of stimulus. Remember those? Yeah, this is not that, because that would be way too expensive for the government. Recently, they've had a big aha moment to stimulate the economy without spending one dime of their own money, but rather spending yours. You see, according to the Federal Reserve Bank of St. Louis, there is more than $31 trillion in U.S. home equity as of the fourth quarter of 2023, and they want to give you access to it, to at least $2 trillion of it, through a massive reform of secondary mortgages. And it's almost assuredly going to happen late summer, early fall, just in time for, you guessed it, the election. But by offering such a large amount of credit to homeowners, and then selling that credit, or debt rather, again on the secondary market as mortgage-backed securities. Remember those?
Stock market tanked, credit dried up.
Yeah, we could see after the election dust settles, a repeat situation similar to the 2008 financial crisis, where many people lost their homes to the shenanigans that were going on in the secondary market. And that doesn't even take into account the current economic pressures that people are experiencing, like record high credit card debt and rising bankruptcy rates, which has painted a picture of an economy really on the brink of collapse already. And people are almost assuredly going to take the stimulus, and as much as they can get to pull through what they're currently dealing with. Makes sense. I don't blame them, because this move, it could help a lot of people, but it comes with consequences. You see, with inflation on its way back up, and middle-class Americans already stretched thin, this new policy could push many into a precarious financial situation. You see, the idea of tapping into home equity to stimulate consumer spending sounds like a good idea, maybe, or not, because it also means taking on additional debt. And like first mortgages, second mortgages also use your home as collateral. Now, this increased consumer spending, this move would likely would almost certainly erase all of the Fed's progress on decreasing inflation, reversing it in the other direction. And this could lead to a dangerous cycle of borrowing, spending, and borrowing to repay what people spent, ultimately increasing the risk of losing your home if the economy should take a downturn. And if inflation takes off again, it could very quickly transform your most valuable asset, your home, into your biggest liability, and ultimately losing it altogether. But could that actually be the plan? Could this be a setup leading to financial instability and creating a tsunami of foreclosures? Here's what I mean. We already know private equity firms have been carving out an increasingly substantial share of single-family homes. BlackRock, Blackstone, State Street, Vanguard, they are robbing Americans of their ability to own homes. According to RFK, one of them has a goal of owning 60% of all U.S. homes by 2030. And then even Jeff Bezos seemingly came out of retirement to get into the single-family home game himself, raising and driving concern about the potential consequences for housing affordability and market competitiveness. And depending on how deep you want to go with the conspiracies, the question you want to ask is, who is going to own all of these second mortgages when Americans start to default? The whole idea of owning nothing and being happy, that could be happening sooner than we expected if we don't stay awake. And then you've got to wonder, are we even being told the truth about any of this? How do we make a decision about anything? If you look at reliable sources like, say, a Newsweek or a Redfin, one source might report dropping home prices, while another claims that prices are stable. Inconsistencies like this, they've got to make you wonder, right? Moreover, certain foreclosure data, such as VA data and FHA loans, that stuff is no longer being reported. And you've got to wonder why. Why is that data now being withheld? Are we getting the full picture? And there's likely to be a disproportionate impact from the stimulus plan on middle-class Americans, because they're among the most vulnerable right now to this economic pressure of additional debt. There's a real fear that we could be on the verge of witnessing the greatest transfer of wealth in history when Americans are given the ability to unlock the equity in their homes and then deploy that into the economy. The stakes, they are incredibly high, and the fear, the financial ruin, is real. So, what do you do? what can you do? Is there any way for you to navigate this without falling into financial devastation? And as bad as that may sound, this isn't time to panic. It's a time to prepare and strategize. We've been given a warning. The risks are real. It's true that home equity could be lost and your financial burdens could increase if you play your hand wrong. But if you play your hand right, this can be a chance to really unlock new financial opportunities. For example, secondary mortgages, when used wisely, they can be a powerful tool for financial growth. Imagine tapping into your home's equity to invest in a new business or additional properties, the types of things that actually benefit from higher inflation. This can diversify your assets and actually reduce risk, leading to long-term financial stability. Think of it as leveraging what you have to build something even greater. This summer, ahead of the presidential election, we're going to see significant changes. Timing is everything, and being informed now means you can act quickly and strategically. The key is to stay ahead of the curve and use these changes to your advantage. Yes, I know that the stakes are high, but so are the potential rewards. The current economic environment, it's ripe with opportunities for those that are ready to take informed action. Economic shifts have always created incredible opportunities for those with their eyes open and willing to take calculated risks. Savvy investors have historically turned crisis into moments of substantial growth. By staying informed and proactive, you can turn potential risks into your greatest wins. And as bad as the last housing market crash was for so many people, the recovery saw the rich get richer. And this is the game, the elite, they're going to play this game again. They're going to make these same strategic moves and win all over again. So here's what they know and what they're going to do. They're going to take advantage of these secondary mortgages because when used wisely, they can be an exceptional tool for financial growth as opposed to a liability. All the Dave Ramsey fans are going to assume it is. But that could be a dangerous assumption when you consider many successful real estate investors began by leveraging home equity to finance their first rental properties. By using the equity in their primary residence, they were able to purchase income properties to help pay their day-to-day bills while building wealth while they slept. The real play here of the elite this time around, and this is it in a nutshell, that's to borrow a depreciating asset, money from your secondary mortgage, to purchase an income-producing appreciating asset, real estate. Now, if that sounds cliche, I get it. There's nothing wrong with ignoring this advice and playing it safe. I get that feeling. I understand. We're heading into some seemingly really scary times. But know that there's a substantial risk in playing it safe. Taking zero risk and hoping for the best is potentially a bigger risk than taking a calculated one. And here's what I mean. If people dip into their home equity by way of these second mortgages, inflation, it's going to skyrocket when all of this money hits the economy. We just saw it happen during COVID. It's not going to be different this time when more money is pumped into circulation and all the progress the Fed has made fighting inflation, it's going to be undone. Groceries are going to rise in price again. Gasoline is going to rise. Restaurants and everyday services, all of that stuff is going to continue to go up. So if you don't tap into your second mortgage and put that money to work, you better have a plan to increase your income so you can keep up with inflation. Those on fixed incomes, hourly wages, salaries without bonus potential, those are the people that lose the most during inflationary times. You don't even have to take my word for it. Just look around. And you don't have to look too far either to see those who are hurting right now. They all fall into the fixed income category. When it comes down to it, most people, they just won't be able to outwork inflation. But if you play your hand right, your money can. Ignoring this opportunity, it means missing out on a potential financial windfall. But what's worse, ignoring it and doing nothing means getting crushed by rising prices. So the key is to stay informed, plan strategically now, and be ready to take action with a strong understanding that taking no action could be the worst thing that you could do. So subscribe to stay in touch, to stay in the know, and I'll see you next time. All right, take care.